Well, that economic momentum seems to be carrying over into the early part of 2022 here anyway, but the crisis over Ukraine, surging inflation, and COVID-19 may be spoilers in the months to come. So for more on the US economy, I'm joined now by William Lee, and he's chief economist at the Milken Institute, and William's here with me in Washington, D.C. via Skype. So GDP grew at 5.7% last year. That's really strong. You have to go back to the Ronald Reagan era to get that. And now we are learning, William, that the fourth quarter was much better than anticipated at 7%. Now, that's odd to me because it was basically the quarter of Omicron, wasn't it? And people were very frightened about that. What do you think happened?
Isn't it amazing that we have a 7% GDP number, annual rate in the fourth quarter, the kind of number we expect to hear from China, not the U.S.?
Yeah.
But if you look into the data, you'll see that 5 percentage points of that growth was due to inventory accumulations. Essentially, the supply constraints in the U.S. has been so severe that the companies and retailers have depleted their inventories. Auto dealers normally have a 60 to 90-day supply of cars, and they barely have 2 weeks supply of cars. So the last quarter is a story of companies and businesses restocking, and a lot of that GDP growth is due to restocking. If you look behind the numbers for consumption and investment, fixed investment, you'll find that GDP only grew about 2%, taking away those inventories. So yes, GDP was strong, but most of that was rebuilding inventories, and even yet not back to where the businesses want them to be. Going forward, the key question is, where is growth going to be? And consumption and fixed investment suggests that it's going to be about 2% going forward, if not less.
Okay, well, all of this is better than 2020, of course, where there was a decline of some 3%. Do you think 2021 might have been stronger overall had it not been for the variants, particularly Omicron?
Oh, there's no question that the decline in consumption during the 2021 has been due to the shutdown of the U.S. economy, both in terms of the service sector shutting down, people not being able to get to their jobs, and yet there was a lot of spending going on because the stimulus checks and the huge, massive emergency measures taken by the government gave people a lot of money to spend, and they spent it on a very small supply of goods and services, which led to a lot of inflation.
Now, face-to-face businesses must have really suffered in the light of what you said, but is it possible to identify what actually thrived in 2021?
The electronics sector thrived. Our imports of Chinese goods thrived. Our desire to have more space was absolutely paramount. So you see the real estate sector was absolutely going berserk. And that in part was fed by the huge amount of liquidity the Federal Reserve was pumping into the financial markets, which allowed people to borrow and get mortgages at incredibly low rates and very readily because of that huge supply of liquidity.
Yeah. Does it worry you? Because I tell you, it worries me a bit. I report a lot from the New York Stock Exchange. I keep reporting that these big US corporations are beating Wall Street estimates. And then I walk out onto the street and I see shop after shop after shop boarded up and restaurants boarded up. I mean, it's like there's a twin economy, isn't it?
Well, the dual economy concept has been a notion in the United States for quite a while. Certain companies, especially the cutting edge high-tech companies, have been able to do phenomenally well. Their profits have been able to grow regardless of inflation because they can keep their prices up. They have a technological moat around their products. But the mom and pop grocer, the restaurant that's on Wall Street, the cafeterias that you and I used to go to on Wall Street, those have been shut down for quite a while.
Okay, well, fair enough. To the big question now then. We started 2022 with great optimism, I know that, and we were worried only about inflation and when the Federal Reserve would move and how much it would move by, and now we are faced with the Ukraine war, and that's how it's being couched around the world. So, I mean, what do you think about the fact we now have a war in Europe? What does that do to growth prospects?
Well, that's the source of a huge shock, both on the price side and on the output side. What we're going to see is that our global supply chain just isn't going to come back together very readily. So the supply of goods and services is probably not going to come back on. The huge spike in oil, which now is hitting 3 digits, $100 a barrel, is also something that's going to hurt the American consumer, the global consumer. So I think the bout of stagflation that we're about to see is going to be a real challenge for the Fed. Will it be able to remain credible in fighting inflation and continue to raise rates in the face of a very slowing economy?
And the Fed lacks credibility anyway, doesn't it? People on Wall Street are not at all sure that they know what they're doing when it comes to inflation. They're not at all convinced of it.
Well, there's a dual economy on Wall Street as well. If you talk to equity analysts and a lot of general analysts, they all say, my God, the Fed has lost the plot. They have completely fallen behind on fighting inflation. But if you look at the pricing of financial securities, where the bonds are priced, especially long-term bonds, you see that the inflation rates that's being priced into bonds, especially in that 10-year horizon, the last half of the 10-year horizon, those pricing is exactly nailed at 2.1% inflation. So there's a lot of credibility among the bond market, the long-term bond market pricing mechanism that seems to believe that the Fed will do the job and keep inflation in check and at target at 2%, but not now, probably in the second half of that 10-year horizon.
The second half, most interesting. William, as always, thank you so much. We appreciate it. Thanks a lot.